Hello, everyone. Let's talk about Treasury bills, otherwise known as T-bills today. What are they, how they can be used, and why you might use them. In a nutshell, they are a short-term form of debt, form of borrowing from the U.S. Treasury. Specifically, it is it's a form of bond, if you will, directly issued by the U.S. Treasury, where they promise to repay you a certain amount at a certain time. It is a short-term obligation where the maturity or expiration or life of this bond, of this bill is, excuse me, is up to 1 year. It could be 1 week, could be a few months, could be up to 12 months, 1 year. They pay interest. Now, technically, they don't pay any sort of interest along the way. You buy them at a certain price, and then on the date they mature, you get $1,000 per bill. These bills are issued in denominations of $1,000 per bill. So the way to make interest is, let's say you buy it today. It's a 1 year bill, for example. So you buy it today, it matures in 1 year from now. So January 2024, you pay, let's say, $960 to buy this one bill. If you hold it for the full time until it matures next January, it will mature at exactly $1,000. So your interest is going to be the difference of the $960 you paid for it versus the $1,000 you get paid out when it matures, or $40 in this case. Now, that's a super basic example. That's a little over 4% annual interest. Again, you paid $960, you ultimately get $40 worth of interest. So that's 4 plus, 4.1 something percent interest for that. So T-bills have been around a long time. They're a little more in fashion now because short-term interest rates or rates, the yields, the interest that these T-bills pay is quite high, especially relative to what they've been over the last few decades. As of the recording this video, and these change daily, but as of the recording this video, you can get a 6-month or 12-month Treasury bill that pays an annualized rate of interest of 4.6 to 4.8%, which isn't bad. And so long as you hold it until it matures to get cashed out the $1,000 and don't sell it along the way, you're guaranteed to get that certain amount of interest. Where again, interest is just you buy it at one price, you ultimately get it redeemed or matured at $1,000 per bond. That difference is your interest. So if you hold it until it matures, you will get the $1,000 per T-bill purchased. That's ultimately your interest. Now, the other benefit of this interest, not only is it guaranteed if you hold it until it matures, but the interest is completely tax-free at the state level. It's fully taxable as ordinary income at the federal level, but regardless what state you live in, even if it is a state that does have state income tax, interest received on U.S. Treasury securities like Treasury bills are not subject to state income tax, thankfully. So you can, if you do live in a taxable state or a state that has income tax, you can squeak out a little extra, net usable money by not having to pay income tax on it, state income tax at least. Now, the interest is all taxable when the bill eventually matures. So, for example, if you buy one today, January 2023, you hold it until it matures January 2024. All that interest is taxable in 2024 when you receive the $1,000 principal payout at maturity. Whatever interest you got will be taxable for 2024 tax year. Now, people often ask, I understand, hold it to maturity, I get this guaranteed payout, i.e. guaranteed interest. Is there liquidity? Can I sell it beforehand? The answer is absolutely yes. You can sell it whenever. It's a freely tradable. You can buy and sell any given day. Now, if you do sell it before its maturity, there is a risk that the price at which you sell it could be less than what you paid for it. So they're not guaranteed if you sell it prematurely. They are guaranteed if you hold it until its maturity. Now, what happens is the example I gave before, you buy a 1-year bill today for $960. In 1 year's time, you will get exactly $1,000 when the bill matures. Throughout the life of that 1 year, the price will slowly climb to $1,000, such that on the day it matures, the price has to be $1,000, no more, no less. Along the way, it can fluctuate a little, but it will trend upwards. The price will trend towards $1,000 for the length of time you hold it. Why does the price move? Well, it's a function of the market level of interest rates. As the short-term interest rates change throughout the life of you holding this T-bill, the price is going to fluctuate a little bit. Again, it's going to trend towards 1,000, but it will fluctuate. So you can potentially lose money on it, especially if you sell it soon after you bought it, and interest rates have risen in that time. The price of your bill is going to drop a little bit. But if you hold it to maturity, or at least really close to maturity, you are going to get a price that's $1,000 or at least near $1,000 per bill. So how do you actually buy them? Well, the easiest way is just through a regular brokerage account. It doesn't need to be a normal brokerage account. It could be like an IRA or a Roth IRA. You can also buy them in there. Basically, any type of investment account that allows you to buy securities like stocks and bonds, you can buy treasury bills in. So whatever your account custodian is, you would log in there. There's going to be some sort of fixed income, or bond trading portal within your brokerage account or IRA account or whatever it may be, and go through the process that way. Now, you may need to call up at some brokers if you're not comfortable doing it yourself. You can do a voice order to call up the broker or the custodian. They will charge you a fee for that. Most brokers won't charge you a fee if you buy or sell T-bills electronically through their trading platform. But if you do talk to a living, breathing person that transacts the trade for you, there almost will certainly be a fee for it, trading commission, if you will. You can also buy them direct from the Treasury through treasurydirect.gov. Now, frankly, I think it's actually easier just to buy them through a brokerage account, but nonetheless, it can be purchased direct from the government through treasurydirect.gov. So how could you use these? You can use them as a portion of your bond investments. Like I said, now T-bills maturing in 6 to 12 months are paying 4.6 to 4.8% interest on an annualized basis. That's not bad. That's a pretty good guaranteed rate of return. If, again, you hold it for the full maturity, you will realize that level of interest. So it can be used for a bond portion of your investments. It could also be a cash-like investment. If you're trying to earmark some cash for 3 months, for 6 months, for a year to like buy a house or something, you're saving up for some big purchase, you don't want that money at risk. Yet you'd like to get some sort of meaningful amount of interest for it. Well, you can park that money in a T-bill. If you hold it for the life of the bill, again, you're guaranteed, you know what you're going to get. So there's no risk of principal loss if you hold to maturity, and the interest is pretty good. So there's varying length T-bills. Like I said, you can buy ones that 1 week, 1 month, 3 months, 6 months, all the way up to 1 year. So anyway, I'm not saying you should or shouldn't. This is not specific investment advice or guidance. I'm just laying it out there what T-bills are, how they could possibly make sense, and what to know about them. All right. Hope this was helpful. Take care. See you next time.